what this chart shows beautifully is the overlay of these two series across 25 years of data, covering every major economic shock since the early 2000s. So this is very good because what does it show you? It shows you some very interesting. Now you notice that the shaded areas are basically economic recessions. And what do you notice? Look what happened during the recessions. So, recessions and shaded regions. You will also notice several shaded gray areas in the timeline. Every one of these recessions has the same pattern. Very important for you to understand. Financial conditions tighten sharply. That's one. Two, the economy falls into contraction. Three, conditions then ease as the Fed intervenes and the economy reaccelerates. Of course, this is great because you're looking what happened in the past, and it's easy to say, "Oh, sure," but what's going to happen next? And this is what I'm going to talk to you about. So this is the power of financial conditions. Financial conditions are often called the transition channel of monetary policy. You need to know that. Now, are financial conditions tightening or easing? Well, because of what's actually determining the behavior, it's across mortgage borrowing, corporate credit issuance, equity valuations, consumer spending, business investment, and labor demand. In this, we consistently see that the real GDP lags the movement in financial conditions. Meaning, first we ease, we make it easy for you to borrow, the market starts going up, and then the economy recovers. So when financial conditions begin to ease, even before the real economy improves. And now, right now, I know there's a lot of discussion is, are we having a recession? Are we heading in a recession? Well, I mean, look at this, what has happened historically. Anytime financial conditions begin to ease, future GDP growth almost always follows upward. Remember what I said in my live yesterday? Then when you look at the stock market performance, we're seeing that, yes, we're mimicking some past historical bubbles, but, and this is the but, we're nowhere near yet. We're following, we are literally, if you look at the chart, and I'll refer you to my live yesterday, if you look at the chart of what happened to the stock market in 2000 with the dot-com bubble, and you look as to what happened very recently. What I mean by that is what happened during the stock market situation. You will notice that they are followed very closely, but we have more room to go. Okay. So let's take a look again back at this chart. So when financial conditions begin to ease, even before future GDP growth opens, look what happened in the dot-com bubble and the early 2000. Okay? If you look at the early 2000, and essentially this is all the way to the left, right? That's the first major recession. Around 2000, 2001, the index plunged as the dot-com bubble burst. And 9/11 hit. GDP dropped sharply. So, I mean, this was a bad time, right? So first of all, you have 2000, where basically, the dot-com, and then of course you have 9/11 in 2001. So then look at what happens next. The Fed cut interest rates aggressively. Financial conditions eased. The green line moves back above zero, and shortly after, real GDP climbs again. This is the first example in the chart. You have this reacceleration pattern, and that's very important to see. It's very important to see because it helps really center the information about what really matters, right? Because at the end of the day, this 2000 bubble really occurred in a way that nobody I mean, everybody could see what was going on in 2000, but then we had 2001, and then no one saw that coming. And that was the issue with that. So next, we're taking a look. Let's take a look at the global financial crisis, and that one, as you could see, this is very thick, right? This is a very thick column there. So the next major shock is a global financial crisis. 2008, financial condition collapsed to their worst reading on the entire chart. As you could see, the green go all the way down. Okay? Nearly -8. Real GDP follows with a deep contraction. But again, as soon as conditions begin to ease in early 2009, the GDP recovery starts to form and growth returns. And that's what I want my subscribers to understand, is I want you to understand what's going on so you could take advantage of these type of situations. But obviously, you need to understand where we are, what is going on. The period also marks the birth of modern quantitative easing, forward guidance, and other unconventional tools that the Fed basically use routinely. They basically say, we're gonna remove some money or add money to the economy to make the liquidity goes up. The correlation between easier condition and rising GDP becomes even tighter after 2009. Then, of course, you've got mid-cycle slowdown. And don't forget, these things go up and these things go down. I mean, it is going to happen. You are going to have a slowdown. And what we do see, what we do notice, is the fact that that's what you're going to see. You're gonna have this situation. Now, 2011, the euro debt crisis, financial conditions tightened modestly. 2015, 2016, what do we have? We have the China slowdown and the oil collapse. And then in 2018, 2019, we have the Fed tightening and the trade war. Then, of course, again, another one. Let's take a look at this chart again, and you could see what goes on in 2000, which is a COVID shock. No one expected this one. The biggest anomaly in modern history is, of course, a pandemic. Financial condition crash in March 2020. GDP collapses, but look how violently conditions rebound once massive stimulus is launched. And that's the beauty of this. Zero rate, quantitative easing, fiscal checks, liquidity injections, credit backstops. Now, the good news is, the Fed has gotten better in doing these things, and hopefully, once you have that next, they will be a lot easier to do. Now we are in 2022, 2023. Tightening cycle. Fast forward to post-pandemic economy. This is where we're in 2022. The Fed launched the most aggressive tightening cycle since the 80s. Financial conditions tightened sharply. GDP slowed dramatically and nearly stalled. But the economy did not break. Everybody say, we're going to go into recession. No, we're at 3%, people. We are not going to go down. By 2023 and into 2024, financial conditions began to ease again. Even before the Fed rate cuts. What do we mean by that? Well, you have rising equity markets, tight credit spreads, improved liquidity, and stable long-term yield. So where are we now? Now, that's a question. Where are we now? And that's the interesting comment that I would make. Where are we now? Well, today, financial conditions today are well above zero, meaning they are easy, not tight. Look what's happening with the Fed, right? Going after the Fed quite enough. Lower the rates, lower the rates, lower the rates. This does not necessarily mean a boom, but it strongly suggests that risks of recession decrease when the green line is above zero. So my view is that, things should be great now. But now, unless you have some 2001 event, You have a COVID event, right? Something that we did not know was going on all of 2008, which is a big surprise to everyone. So indicates credit is flowing. Household and firms have access to financing. Equity wealth effects support consumption, and liquidity remains strong. Financial markets are not restricting economic activity. But don't underestimate how much easier conditions are and what that means for future growth. Don't underestimate. Don't listen to whatever it is that they're telling you. So, what is our implication for investors and policymakers? Right? I mean, what does it mean in terms of that? That's the interesting question. Well, I will say this. The Fed will look at this and see no justification for emergency cuts. So easier condition means the economy may actually heat up, not cool down. Although I'll show you another chart and you'll see that that might not be the case. 2, market pricing may be too pessimistic about growth. The market is saying, oh, we're not going to grow enough. We're going to have issue with AI. Number 3, investors must respect the macro backdrop. You need to understand what is it that the environment that you're in. You need to realize when conditions are ease, risky asset historically outperform. So in conclusion, the chart is sending a powerful message. Even if the headlines feel uncertain, the underlying conditions point towards renewed momentum in the U.S. economy. Do not. I keep telling my subscribers, my Patreon channel members, where I actually provide actual recommendation, not to listen too much to what is out there, because more often than not, they don't have your best interest. They have their interest, right? They want you to take views. They want you to subscribe. They want you to buy the newspaper or listen or view, right? They want to keep the eyeballs going. But the purpose of this channel, and that's why I want you to subscribe, is to educate you as to what is going